So this dividend investing video, this one is for the haters. There are haters out there on the internet, in the comments, elsewhere, saying that, hey, dividend investing, it just does not work. Flat out does not work. And so sometimes I even get comments saying, Ian, the math doesn't make sense, this or that. And so the purpose of today's video actually is to explain why dividend investing does work. But usually the haters, they come from two angles. There's one or two arguments that they have. The first argument that they have is they point out stocks like Kraft Heinz, complete losers, and they point out, hey, look at this stock, this dividend stock that all these dividend investors like. This thing has fallen off a cliff. It has done so poorly. And so they cite something like that, and then they extrapolate, well, you're just buying stuff for dividends, but the share price is always falling. So what's the point of that, investing for dividends, if the share price is just going to fall? That's argument number one. By the way, I'm going to use math today. I'm going to use a sample portfolio. A lot of my subscribers have been asking, Ian, I'm just getting started out. What does a sample portfolio look like if you were just starting again? Because I've been investing for over 20 years in dividend stocks, so I own 41 positions. I've got a big portfolio. But people ask me, Ian, if you were starting over again, what would your sample portfolio look like? And so I'm going to share that with you today. It's over here right now. You can see some of those pie charts, and I'm going to go into great detail today about what a sample portfolio could like, and I'm going to use that actually as my basis to explain how even owning a stock like Kraft Heinz, the dividend strategy can still work really well, even if one makes the mistake of owning a loser stock like that. So that's argument one that we're going to talk about today. The other argument that these haters, these skeptics come at is basically they say, hey, dividend stocks, when a dividend is paid from a company, the share price, it notches down accordingly. Basically, the day before the dividend is paid, the share price is here, dividend is paid, share price steps down to here at the opening bell the next morning. And that is true. And so they argue, hey, because of that, dividend stocks, it doesn't matter whether they pay the dividend or whether they keep it, the share price notches down accordingly. And so that is true, but it's also wrong when someone looks at things through the broader picture. And so I've actually talked about this concept before, especially in my earlier videos, but I want to reiterate it a bit today because it's totally related to this concept. Now, I know a lot of you out there in the community, our community is growing. 33,000 dividend investors strong. So blessed. I love you all. The amount of beginners here recently in this community, it's notching up. There are a lot of beginners here on this channel, and they're just trying to figure things out, how to get started. And they're even wondering, is dividend investing for me? Is dividend investing the right stock market strategy for me? And I cannot answer that for you. It is for me. I can certainly say that. Been at it over 20 years, working really well for me. I'll share in the description below. You can download my stock portfolio. You can see what I'm all about. But as you find out which strategy works for you, it may or may not be dividend investing, but the point of today's video is to dispel some of the myths out there, as there are a lot of myths around dividend investing, and I just want to set the record straight that dividend investing, it does work, and it does work really well, and it works really well even if someone makes the mistake of owning a stock like Kraft Heinz after it has dropped so much. And so let's get started with today's dividend investing video. All right, everyone, so I have my laptop yet again, and I'm going to refer to a spreadsheet on my laptop. By the way, I'm going to link to this spreadsheet in the description and also in a pinned comment below. You can just download this spreadsheet to follow along at home. I'm not going to make you sign up for my email newsletter or anything like that. I'm not going to direct you towards some affiliate link like so many people do. Literally just sharing my best content, my best work here on YouTube for free. And so I will be sharing this spreadsheet in the description below and in the pinned comment if you want to follow along at home. And so this is going to be the basis of argument number one when we talk about argument one, stocks like Kraft Heinz. So let's look at Kraft Heinz. Today is August 13th, and so right now Kraft Heinz is trading at $25.89. This is an intraday price that I pulled. Now, 1 year ago on August 13th of 2018, it was trading at $59 and change. And so if someone bought Kraft Heinz a year ago, held till today, they are down 56.33%. Now, this is the precise argument that a lot of people use to say, hey, look, you're down. You bought this stock for these dividends, and these dividends are nice. You're getting your 4, 5, 6% yield, whatever it is, but depending on your purchase price. But they basically say, hey, what's the point of that yield if the stock is just going to go down? Well, the point is that not all stocks are like Kraft Heinz, and if you've been following my channel for a while, I warned the community. Now, I don't give any investment advice on my channel, but I did warn the community saying basically, look, I am not buying this. The reason I'm not buying it for my personal portfolio is X, Y, and Z. And so I will link to those videos in the description below. And of course, I'm not providing advice. I'm only talking about my personal journey here. But the reason I'm bringing that up is not to poke fun, by the way, at anyone that did buy this. If you bought this, I feel for you. I've bought stocks that have gone down before, and so I understand what it's like. And so I'm not trying to say like, hey, I'm above anyone else or anything like that. I've made all the mistakes in the book. I probably made more mistakes than anyone. And anyways, the reason I'm bringing this one up is because it's a really good example of diversification. We're going to talk about that in a minute. But again, the reason I'm bringing up the fact that I warned people about this in a sense is to show what an experienced investor is capable of. I'm trying to show as you in your journey become more experienced at dividend investing, you learn more things, you'll kind of be like me. You'll develop that spider sense. You'll develop that sixth sense where you're really able to kind of sense these stocks ahead of time and be like, hey, been there, done that, seen that. I know this thing is going down. And that's kind of what happened with me and with Kraft Heinz. And that's the point of furthering your own education and learning as much as you can about dividends. But I'm not trying to brag. Seriously, I've made all the mistakes in the book. I've lost a lot of money before making mistakes. And so if you have lost money making mistakes, I'm not trying to say anything like I'm above that because I've done it all. So anyways, yeah, if someone just bought Kraft Heinz as the only stock that they own, yeah, the dividend strategy with Kraft Heinz wouldn't work. And so I think what a lot of these skeptics believe is they believe all dividend stocks are like that. All dividend stocks, they must be like Kraft Heinz, but that is not the case. And so that's the purpose of my pie charts today. That's the purpose of the spreadsheet that you can download is I just construct a simple portfolio. And so I'm saying, hypothetically, what if I built a portfolio? I started a portfolio a year ago in August 13th of 2018. And let's say I bought Kraft Heinz. Well, hypothetically, I bought Kraft Heinz. I made that mistake. But what else would have I bought at that time? What are the stocks I likely would have purchased? And so in this sample portfolio, I have other stocks. I have Johnson & Johnson, my number one favorite stock of all time. I have PepsiCo, my number two favorite stock of all time. McDonald's, my number three favorite stock of all time. United Tech, my number four favorite stock of all time. And I put Realty Income in there as well to have exposure to real estate, although McDonald's has that exposure as well, as so many of you have pointed out in my last video. Thank you for doing that. And so before we even get into too much further, I want to explain, well, how did I come up with these stocks? Look, hypothetically, in this situation, I'm just saying, hey, I'm a beginner. I'm starting out. It's August of 2018. What 5 or 6 stocks would I buy with 10 grand? I would probably, honestly, go with a mixed bag based on industry. And so I like these stocks because I have healthcare with J&J. I have food with Kraft Heinz. I have food with Pepsi. I've got real estate / restaurants / retail with McDonald's. I got real estate with Realty Income. And I've got a diversified industrial company with United Tech. They also happen to be my favorite stocks, and so I get this question all the time. Ian, if you were starting over again, how would you orchestrate your portfolio? And what would you do, especially if you had a portfolio that was like $10,000? Well, if I had a portfolio that's $10K, I'd probably buy 5 or somewhere between 4 and 6 stocks. Probably 5. I did 6 in this example because I had Kraft Heinz in there as a hypothetical. But the fact of the matter is I probably would do something like this because I would pick my best stocks. I would put my best foot forward. I would not just go for deep discount, deep value. You guys hear me talking about deep value here a lot. I do that, but they're ancillary positions. And certainly if a core position is on sale and it's a deep value, I go all out for it. But if I'm constructing a new portfolio, I'm not going to put 100% of my money in deep value stocks. I'm going to put my best foot forward. Maybe I'll pick up 1 or 2 value stocks, but I'll try to really round it out with core positions. Those positions that I love, like J&J, Pepsi, McDonald's. Even if they're at fair valuations, they're not on deep discount. Look, I'm just getting started out after all in this situation. I would rather start out with solid foundation, with solid bricks, than build it on kind of riskier bricks. The riskier bricks can come later, at the top of the pyramid, but that foundation has to be really solid. And so a lot of people ask me this. I'm going to do another video on this, by the way, where I get into a lot different detail based on different portfolio sizes. And I'm going to do it right now for August of 2019. But I'm just saying, hypothetically, August 2018, if I were building a new portfolio, I'd probably build something like this with 10K. And Kraft, by the way, perhaps, what if I bought it at the time? If I hypothetically did buy it, I would probably consider that the value stock, the deep discount stock. And so out of these, the risky stocks, so out of these 6 positions, and I divide the money between them pretty evenly. You can see that in the spreadsheet. I put 1,700 in 4 of them, and I think 1,600 in 2 of them. Yep. And so 1,700, by the way, I put in Kraft Heinz. I went big on the value, the risky one. But yeah, if I were building a new portfolio, I got the core stuff, and maybe I throw in a value stock, a deep discount, like a Kraft Heinz kind of stock. Even though I would never buy Kraft Heinz, I'd say the closest thing I would say to it today, if I were building a portfolio of 10K, maybe I'd put in AbbVie. That would be kind of the risky, the deep discount stock, the risk stock that I would put in there. But I certainly wouldn't make my portfolio brand new, just getting started out, all AbbVie, or I wouldn't make it, I'm talking about with 10K, I wouldn't make it all stocks like AbbVie. I would diversify. Now, I'll tell you guys, one thing that's always been a rule for me, and this is backdating since when I just first started my portfolio. For me, I always felt just psychologically, if I had less than $2,000 in a stock, it just wasn't really enough to warrant having it. And so that's why with 10K, I come up with 5 stocks, maybe 6 if I stretch it, which I did in this case. But I just never felt like less than 2K, it's worth my time. And so that's why with portfolios that are a little smaller, like let's say I was starting with 5K, maybe I just own 2 stocks. Or if I'm starting with 1K, maybe I just buy 1 stock. And so we'll talk more about this in future videos, but I want to hint at that as I'm getting a flood of questions. And especially on my Facebook group, which I'll link to in the description below, everyone is invited. This is dividend investing for everyone here. And so now my threshold has actually stepped up because my portfolio is bigger now. And so now it's not 2K anymore. I have a higher threshold where if it's below that threshold, it just doesn't make sense for me to own it. But that's kind of how I get my number of positions when I was just starting. So I just felt, again, less than 2K, just not enough. At least that's just psychologically, it's just a rule of thumb that I came up with at the time, and it served me very well, I feel. So anyways, I wanted to share some stuff. So Kraft Heinz during the last year, yes, it's down 56%. But if you throw in these other blue chip companies, and mind you, none of these were really on deep discount a year ago. Maybe McDonald's was relatively to where it is now. And mind you, none of these are technology companies. These aren't high-flying FANG stocks that really weight the top 10 of the S&P. They're really weighted in these FANG stocks that, like Google or Facebook or Amazon, these types of companies that have just gone parabolic, if you will. They've accelerated their trajectory in terms of capital appreciation. Mind you, I'm just picking household names here. And so what happened with J&J over the last year? Well, it's only gone up 1.7%. It's been flat. What's happened with Pepsi? It's gone up a respectable 14%. McDonald's, as I mentioned, this one did well. It went up 38%. Realty income actually did really well as well. It's up 28%. I think some of that is due to tax law reform as it pertains to real estate investment trusts. And so I think that has propelled more people to put money into that sector. And so that stock has been bid up. But look at United Technologies. That one's down. It lost 2% over the last year. And so what's really, really interesting is overall, over the last year, if I compare August 13th of 2018 versus August 12th intraday 2019, my dividends, this hypothetical portfolio on capital appreciation, it's only up, it's up 3.78%. Now that doesn't sound very exciting, but there's something I want to point out here. Well, first, this beats the S&P 500. So during the same period, the S&P 500 is up 2.73%. So here, we're a whole 1% above the S&P 500 with this hypothetical portfolio. Again, I'm linking in the description below in my pinned comment if you want to follow along at home. Spreadsheet has a lot of columns, a lot of metrics, good stuff for people who are trying to learn more about how I look at dividend stocks. And so the key takeaway here, though, is look, yeah, Kraft Heinz, it is a loser. It is a dog. It is a real loser within dividend investing. And yeah, a lot of dividend investors bought this stock. And while I didn't buy Kraft Heinz, I've lost money on other stocks in the past. I've bought losers. This is why I diversify. I diversify because it saves the day. It just saves the day. And here, literally, this isn't that much diversification. I own 41 stocks, but you look at this sample portfolio, this is just 6 stocks. But what happens is when you own 6 stocks instead of 1 stock, if I own just Kraft Heinz, I would be down 56% over the last year versus the S&P being up 2.73%. But because I have diversification, I am up. I'm up 3.78% overall versus the S&P at 2.73. I'm beating the S&P. And so I cannot encourage enough. If you're thinking about dividend investing, you're just getting started out, the takeaways here are to be careful about the value trap. It's okay to own deep discount values in the portfolio. I've got them. I've got AbbVie. They carry more risk. But I also have a real solid core. I have a real solid foundation. And so that's kind of takeaway 1. Takeaway 2 is diversification saves the day. I think takeaway 3 is these haters, they'll just pick a stock. Maybe it's not Kraft Heinz. Maybe it's General Electric. Maybe it's something else. And they'll be like, yeah, I told you dividends doesn't work. That strategy doesn't work because that one stock. But the one stock is not representative of all the stocks. And there's this misnomer. There's this misunderstanding that dividend investors, they're buying, they just get their dividends, but the stock prices don't go anywhere. They go nowhere but down or flat. That's not the case. If you look at this portfolio that I'm sharing, just over the last year, McDonald's, it's up 38%. Now, I'll tell you something. I don't care about these capital gains because I never plan to sell. The only reason I care about capital gains is in the long run, they're an indication that the company is being well managed. They're an indication that management's doing its job. It's an indication that, hey, revenue, earnings, they're going in the right direction. But other than that, capital appreciation, it doesn't do much for me. I'm not planning to sell stock to pay bills. I would never want to get rid of the goose that's laying the golden eggs. I'm taking the golden eggs. I'm using those to pay bills. Actually, right now, I'm only taking some of those golden eggs. Most of them I'm reinvesting to snowball my portfolio bigger. But I am using some of the golden eggs now to pay bills. And that's a recent change for me. And so diversification, diversification, diversification. Don't listen to the haters. The haters will always latch onto that one stock. I'm sure I can pick tech stocks, growth stocks that are like Kraft Heinz, have gone nowhere but down. And so it's every story has 2 sides to it. And so let's move on though. On this spreadsheet, I also have some more data. I just want to talk about percentage allocation. Here's what's so funny. When the pie starts out, you see it over here. Everything's pretty even. Most of these positions, they're either 16 or 17% of the portfolio. I went pretty even on all of them. After a year has passed, the pie chart, it changes. You'll see it over here. The Kraft Heinz position, for example, it's only 7% of the portfolio. But now this one, McDonald's, is 23%. So it just goes to show that over the course of a year, the pie can change. The pie can change quite a bit, and that's why I diversify, because the winners, they compensate for the losers. And so I'm someone who likes to sleep at night. I'm going to be completely living off of dividend income, and my family will at some point in the future. And to prepare for that, I need a rock-solid diversified portfolio. I could never rely on just a few stocks. And so something to point out. So something else interesting is we did not even talk about dividends yet. Dividends, this is the whole purpose of my channel. And so in my spreadsheet, I also share dividends. I share the current yield, but more importantly, the yield on cost for these positions. In this analysis, I'm doing a simple yield on cost. I'm just looking at dividends now divided by share price, what I paid. And so that gives a sense of how much money am I yielding on the actual cost. I do the same actually for S&P as well. And so overall for this hypothetical portfolio, just after 1 year's time, the yield on cost is a 3.15%. And the comparable yield for the S&P 500 on cost is a 1.93%. And so what's funny is, yeah, this portfolio, even with the loser, beat the S&P capital appreciation wise. But most of us here, we're probably not here for capital appreciation. We're here for dividends. And this portfolio also beats the S&P on dividends, on dividend yield on cost. And I don't even include the benefit of reinvestment here either. I'm just assuming along the last year I've taken the dividends, used them to pay bills. And so really, really interesting stuff. And so I want to put that into dollar terms as well. After 1 year, the dividend income I'm receiving on the 10,000 investment is $315 per year, and S&P comparable is $193 per year. So again, you can just see from a cash flow perspective, there is a huge delta between the S&P strategy and even this kind of dividend portfolio that is made a little bit crummy because of including this Kraft Heinz. But again, do not get down on yourself if you own Kraft Heinz. Hey, maybe it'll turn around from here. I just don't know. The only reason I detected this thing ahead of time is 20 years experience, made every mistake in the book, and have learned over the years from my mistakes to develop this spider sense to kind of determine, hey, I think this one is going to face troubles. All right, so that's the first part of today's video. Again, you can download the spreadsheet. Just link to it in the description below. If you enjoyed so far, please consider dropping a like, or subscribing, or both. It means the world to me. But I want to go on now to the second part of today's video. And so there's this argument that the skeptics also make is, hey, dividend stock is trading here. Next day, dividend is paid, starts trading down here. Market makers, stock market, adjust it for the dividend paid, because the dividend, say this $100 stock is trading at 100. They pay $1 dividend, the quarterly dividend. That would be about a 4% yield per year. Okay, next day trading at 99. That's where it starts, because they took the dollar out of the company and gave it to me, the shareholder. And so that is very true. And so what people say is, hey, dividends, it's really irrelevant whether they pay it or not. And if they pay it, it goes in my pocket. If they keep it, it stays in the company's pocket. Technically, that is true. But let me tell you something. How many of you out there work at a company? Raise your hands virtually, or put it in the comments below. How many of you have complete faith that the company that you work for is better off managing your money than you are? I don't. I've worked at a lot of companies over the year, and I've worked at really good companies, really frugal companies, scrappy companies, where I would trust that they're really good at managing the money. But I've also worked at other companies. I've worked at companies where some of the parties are probably a little bit too excessive. Some of the, quite frankly, compensation packages for the senior executives, they're a little too much. And so what it all comes down to is getting money out of the company into my pocket. The shareholder is the best thing the company can do. And it's a sign that the company cares about me as a shareholder. It's a sign that the company is looking at things the right way. They're like, you know what? It's not our money. It's the shareholders' money. Less money in the company's pocket is less money that they could squander. Less money in the company's pocket is less money that is tempting for someone to do something bad with. Quite frankly, there's a lot of acquisitions out there happening. There's pros and cons of acquisitions. Usually I'm more of a fan of organic growth versus acquisition growth. Less money sitting around is a less chance that a company is going to waste it on an acquisition. And so there are so many reasons I don't want money sitting at the company. And so, yeah, technically the stock goes down. But in the long run, quite frankly, that's really short term. That's literally looking at the close here and the open here. long term, it all smooths out. And oftentimes, dividend stocks over the long term are some of the best performing stocks out there. And I think it's a mentality thing because they're more mindful of the money. And they're more mindful of who really owns the company, who deserves that respect, thug life. It's the shareholders. Shareholders got the respect. They deserve the respect. Look, the employees, the management team, they deserve respect too, and much love, much respect to them if they're actually shareholders like I am, and they worked hard for their shares and they weren't compensated with too many shares for doing too little, especially at the exec management level. Much respect, much love to them as well. But it's the shareholders that deserve the credit. It's the shareholders that deserve the money. And so, yes, whereas in the short run, these haters will say, yeah, it doesn't matter, keep it at the company or give it out, whatever. Well, it does matter because I'd say it's the thing that matters the most because it's a signal that the company has the right values. I'm a values-driven person, values-driven investor. Values are really important to me. And when I see a company that doesn't pay a dividend, sometimes maybe it's a smaller company and they can't afford to, fine. But if it's a big company and they're just hoarding cash, honestly, I look at that as a misalignment of values. I look at that as, do they really have the right values here that they're treating me as a shareholder, that they're just going to hoard this cash and keep it from me when it's my rightful money as a shareholder? And so it's a values thing, and the values trickle down to everyone in the company. And quite frankly, when a company pays a dividend and management team and employees have the opportunity to own stock, I think the values reinforce even more. And so I would say it's a performance thing as well, and it's a values thing. And the values lead to performance. And I would say by paying a dividend, it can help the long-term performance of the company because they're just looking at things. They're looking at it the right way. And I understand a lot of tech stocks, a lot of newer companies, they don't pay a dividend yet. Maybe they will in the future. And sometimes things change over time based on where the company is in its trajectory. And so that's something to be mindful as well. And look, you guys know if you've been around here a while, I'm not putting down any strategy. I love all the investing strategies. I found one that works for me. That's what I'm championing here on PPCE and Dividend Investing for Everyone. You found something else that works for you. Awesome. I love it. Everyone has to double down on what works for them. That's exactly what I'm doing here on PPC Ian. So that's my video for today. If you enjoyed the video, please subscribe. Please give a thumbs up, like, comment. All that means the world to me. I'm glad I was able to share a sample portfolio today because I'm getting so many questions about that, and I'm going to do more in future videos. And please download that for free. Just click the link. It'll download in Excel format, and you'll be able to see these cool charts and all the data behind it. So before I leave today, in terms of full disclosure, I own most of the stocks mentioned today. I don't own Kraft Heinz. I got lucky on that one. But I do own Johnson & Johnson, ticker symbol J&J. Pepsi, ticker symbol PEP. McDonald's, ticker MCD. Realty Income, ticker symbol O. And United Technologies, ticker symbol UTX. Oh, and I can't forget AbbVie, ticker symbol ABBV. I own all of those stocks in my personal dividend stock portfolio. I'm long all of those stocks. In terms of a disclaimer today, friendly disclaimer, today's video is not investment advice. I'm not a licensed investment advisor. Today's video is just for your fun and entertainment. If you're going to go out and invest in the stock market or anywhere else, please consult a licensed financial advisor first. Literally, just sharing my journey here, everyone. And if you want to check out more disclaimers, disclosures, check out the description below. Got a lot of them. And so, I'll see you all in the next video. I'll see you in my Facebook group, which I'll link to in the description below. I'll see you in the comments below because I am trying to respond to most of those comments. I'm a little bit behind. I'm doing my best because we're growing. And so I love you all. I wish you an amazing week, fabulous week. Share in the description below your personal perspective on diversification. That's the name of the game, in my opinion. I love it. Love diversification. And we talked, by the way, I'll plant the seed. We talked about diversification here by company. And honestly, if I were deploying, just starting out 10K, I'm just talking about my personal journey, I'd probably just deploy it all at once. But it depends on how big 10K is to you. If 10K is like really significant to you, there's another way of looking at it too. There's time diversification. So what I'm trying to say is today, I talked about just stock diversification. But as I'm talking about building new portfolios in the future, hypothetically, I'm going to talk about time diversification as well, because there's this concept of averaging in. Perhaps I don't have to deploy 10K all at once. I could take 2K, per month and deploy it over a course of some months. And so that's another way to look at diversification. Want to plant that seed, but just trying to keep it simple today. And I'm just saying, hypothetically, if I were starting all over at 10K, even in this market, even overpriced, knowing that 10K is just the starting point. This is a community. I want to reinforce this point. This is a community, in my opinion, of future millionaires and multimillionaires. And quite frankly, folks who have hundreds, or if they're not a million, hundreds and hundreds of thousands. We are big timers here on PPC, Ian. And so knowing that that's where the journey is leading to, in my humble opinion, that's why starting with 10K, even in a market like this, kind of lofty, I'm just talking about my personal self, again, 100% personal, but I probably just deploy it. I'd probably just deploy it at once. And so if I was starting with, say, 100K, I'd probably average in over a few months, maybe 6 months time. But again, we will get to that in the next one or in one of the future ones. All right, everyone, I love you. I'll see you in the next video.